to improve on the margin significantly going forward. There's probably some room because as we have even more throughput through our fixed cost base. And the reason why our margin has improved is because we've got a fixed and semi-fixed cost base and a lot more throughput. And we are optimistic about a number of our businesses. And yeah, they could edge up the margin a bit further. And it is overall dependent on the economic situation and what is happening in the global front as well.
So when you're saying edge up further, are you saying that it could edge up closer to 10%, or do you think that this is probably a very nice, sustainable kind of number?
No, we would be happy with half a percentage point even would be great. And obviously at the same time the top line growth, so the whole business is growing all along.
Looking at your logistics margins, we saw that came down to 5.5%, and I know that you cited the CIC acquisition as a contributing factor to this. Do you expect the CIC acquisition to be a drag on margins in the future? What kind of play do you think it'll have?
See, CIC have got lower margins because it's active in consumer products, which is generally a lower margin industry. But that doesn't really matter because ultimately the returns on capital is the important thing. And CIC has very high yields on capital. So although it brings our margins down, it's actually a contributing factor to the good 23% return on equity and the high return on capital. So we're very positive about the business, and notwithstanding the fact that it's a lower margin business.
Well, let's touch on CIC because it has been one of your biggest acquisitions, and we know that it obviously operates within the SADC region. Give us your sense with regards to doing business in Africa. You were talking about the fast-moving consumer goods space, of course, a space that many companies want to be in right now. Strategies going forward, is it about expansion and taking hold of Africa even further?
Yes, look, Africa is a very, very big place, and there are a number of countries where we're active in the SADC region. Generally, Africa's countries more on the east coast. We are now recently into some activities into Angola, and distribution of consumer goods is a very good place to be in Africa, fast-moving consumer goods. And you know, we don't only trade with the larger retailers, the smaller retailers, and some of the traditional shops actually purchase through wholesalers from us as well. So there's a very large market where we play in our consumer goods distribution in Africa, and that's a business which will grow. We'll put more capital into it, and we think it has a very long run ahead of it.
Well, it sounds like there is quite a lot of room for expansion. Then this is when we can bring up your cash position. It's sitting at 2.9 billion rand. Tell us about how you're going to be putting that money to work. Is it about CapEx spend and expanding further onto the continent within the FMCG space, or is it about acquisitions within the continent? Yeah,
it would be a spread of priorities. We've spent about 1.5 billion on capex this year, and we always believe some of our best opportunities are where we spend on our own assets and where we simply grow new opportunities ourselves. But we've also always been a very acquisitive organization. Over the last 2 years, we've probably made about 15 acquisitions. We've added about 7 billion of annual turnover to our business in acquisitions. And it would be in logistics, it would be in South Africa, in Africa. Our European logistics is an important growth area for us. And then the distribution of other products outside of purely the motor vehicle market, where we're very good in distribution. Industrial products, aftermarket parts, certain leisure products are areas which are interesting to us. And we've now disclosed in these numbers that in those areas we have over 400 million of operating profit. And this is a business that's come from virtually nowhere over the last 3 years. So we've grown a whole new area for us, and that's making a big contribution to the total mix.
Tell us about the crisis and the impact that's had on Imperial's thinking down the line with regards to cash on the balance sheet. And we know that a year ago you certainly weren't sitting with 2.9 billion rand. Are you going to keep a very healthy cash position on the balance sheet going forward, given the fact that there is a lot of uncertainty in the global economy?
Yeah, it is a good time to be reasonably conservative and not to overstretch yourself, and you know, therefore conservative levels of gearing is probably okay, but we are way under our target gearing level. Our target gearing level is in fact between 60 and 80%, and we're at 30% right now. So we do have capacity to grow and to take opportunities that come our way.
With regards to the vehicle division, we know margins are sitting at around 2.9%, 97,000 units sold, which is quite an astronomical number. You have been saying that we could actually see a slow in growth within the sector going forward, but it seems that you are very confident about the brand position that you've got with regards to importation of products. The rand obviously is working in your favor right now. Tell us about the strategy going forward.
Yeah, the 97,000 vehicles are between our automotive retail division and our distributorships division. So it's the whole mix of all of our motor car retailing activities. But our brands are very well entrenched. The product supply of our brands are at the moment very, very strong. So we are optimistic that business, notwithstanding a high base, we're optimistic that that business is strong going forward. And our strategy is to further entrench our existing brands, to also add other businesses to the mix of our vehicle business, so that we've got a very good synergies right through the value chain, that we fill all the opportunities in the value chain of the motor car industry. And in that way, even though we're a big player in the industry, we will find more growth opportunities.
A tourism division, and I think this is a division that a lot of investors love talking about, because it's got very high margins. It's a very small part of your business, and some say, well, what is Imperial going to do? Is it about selling the business, or is it about making it bigger? So here's your opportunity to tell us, what exactly are you going to be doing with this division?
Over the years, the tourism business in Imperial have actually been quite a gem, and it's a business exactly as you say, which have got high margins and have got good yields. Particularly now, the tourism industry is just in a difficult period, and it's because of international travel is quite low, and the strength of the currency is against us. South Africa is a relatively more expensive destination. But we don't make short-term decisions. We believe South Africa is an excellent tourism destination. There's significant opportunities. And we would grow, with the right asset-light opportunities, we would grow the tourism division. And the acquisition of EduSport this year is a good example of that. We were always looking for a business that's in sports tourism, a business that is in incentive tours, inbound and outbound. And the outlook for EduSport is very good, and it will boost the portfolio as what our objective is of the tourism division.